What's up everybody, I'm AK and welcome to the Minority Mindset. Stock market crashes are painful, there is no doubt about that. And if you think you're not gonna face one, well, you're wrong. Because market crashes are gonna keep happening. They might not happen all the time, but yes, they will absolutely happen again. In fact, 3/4 of economists are predicting that a recession will happen in 2021, which could very easily come with a market crash. So, in this video, we're gonna talk about 3 ways you can protect your money during one of these crashes. The first thing you can do to protect your money in a stock market crash is own some government bonds. And when you're thinking about government bonds, you can think of US Treasuries. And basically all a bond or a treasury is an agreement with the government that you're gonna lend them money, which they are gonna pay you back over time with interest. It's that simple. With treasuries, you're loaning Uncle Sam some money because, you know, he just needs so much of our money all the time. But he gives you interest back, so it's not a bad deal. But here's the thing, you can also buy and sell government bonds just like stocks. So because government bonds are considered really safe because they're backed by the government, their value tends to increase in times of turmoil like a market crash. So when stock prices are going down, the price of government bonds goes up. And if you're owning those government bonds, you're in a good situation. Investors like to buy these bonds when they get scared. It's called the flight to safety. So instead of just owning all stocks, if you own some bonds too, you're gonna have some protection when the crash comes. Just take a look at what happened to the bond market in 2008. The price of bonds shot up 30% while stocks completely crashed. So having those bonds during a stressful time is gonna really help your portfolio. The second way you can protect yourself during a market crash is to have a diversified portfolio of stocks. You never, ever wanna put all your money into one stock. That is stupid. Because guess what? If something happens to that stock and it goes bankrupt, there goes all your money. And when you're facing a market crash, there are a lot more companies that are gonna go bankrupt than normal. In tough times, only the strong survive. So you wanna make sure you own a bunch of different companies so that all your risk isn't just in one. That way, if one of the companies you do own goes bankrupt, well, you're still gonna be okay because you have other money spread across other companies. And like I said, in a market crash, things can get really bad. It's not just bad companies that are going bankrupt. There are some really solid companies that have been around forever that pretty much reached the brink of extinction. In 2008, Bank of America, yeah, the solid bank that everybody knows that's been around forever, they crashed 90%. If you invested all your money in Bank of America, which you would think would be a good investment, you would have lost 90% of it. That's why you need to be diversified so something like that doesn't happen to you. One easy way to get diversified is through an ETF, which is an exchange traded fund, which basically just groups a bunch of companies together. You buy one share of that ETF and you get exposure to all these companies. So take for example the SPY ETF, which is the S&P 500 companies. You get exposure to all of those. In 2008, that fell 50%, which is still pretty rough, but it's much better than that 90% fall in Bank of America. Even with a 50% fall, you're still gonna live to fight another day, which is the point. You don't go bankrupt. And if you're interested in buying an ETF like that, then you should definitely check out our 5-step guide that we put together that's gonna teach you exactly how to do that. It's completely free when you sign up for our stock market newsletter, which you can do through the link up here or the link down below in the description. Now, the third way to protect your money in a stock market crash is to invest outside of stocks. Instead of putting all your money into the stock market, why not put some of it into something like real estate? Real estate is a different asset class than stocks. They're not as closely tied together. So if stocks crash, there's a better chance that real estate will be okay. So once again, it's diversification. Just like we wanted to diversify into different stocks, we also want to diversify into different asset classes. That's how you protect yourself when one asset class is crashing hard. Plus, real estate is a physical asset that is going to pay you a passive income in rent every month. No matter what happens to the value of that real estate, you'll keep getting paid in the rent. Also, prices in the real estate market do not move as fast as stock prices. So it's going to be much easier on your psychology when you see the price of whatever real estate properties you have not moving with the same speed as your stocks crashing. Thanks for watching. If you like this video, then make sure you smash that like button and share it with one friend so we can spread the word. And make sure you subscribe to the Minority Mindset YouTube channel and hit that notification bell so you never miss one of our stock market videos, which are released every Monday at 7:30 a.m. Eastern. Also, if you want more of me, you can check out my personal channel at Fallible, where we release 7 days a week all about markets and business. I'll see you in the next video. Bye.